Welcome to the current federal tax developments for the week of August the 19th, 2019. Current federal tax developments are brought to you by your state society of CPAs and by Kaplan Professional Education. This week we're going to look at a few things that happened in the area of taxes, including a rare taxpayer win, and guess what, to put that in quotes, on a Cohen-style defense. We also found an IRS revenue ruling that tells us about the situation if somebody receives a qualified plan distribution but just doesn't quite take the check to the bank in the current year. It might not surprise you that that's still going to be a taxable issue. We look at whether an estate has the ability to claim basically a hold on the statute of limitations for claiming a refund based on the economic disability of the executor or personal representative. And the answer is also unfortunately going to be no. And the IRS announced this week they're going to be sending out 40,000 checks, or 400,000 checks I should say, make that 10 times larger, related to estimated tax underpayment penalties from last year. And we'll talk about how that's going to work and the potential that you need to get your clients ready for getting one of these letters. Well, this is a week, again, I'm going to be heading on the road for my final travels before we get to all the extension due dates. So I'll be sitting in here from early September through mid-October doing all of those neat things. Then I'll come back out and hit the road. Got a couple of courses coming up this week in Sioux Falls, South Dakota, for both the South Dakota and Iowa Societies of CPAs. And obviously, depending upon when you're listening to this, we may be already in one of these sessions or we may have both of them done. It kind of depends when you pick it up. But if you pick it up early, we do have a couple of them coming up, and you can still see about getting in. On Monday, we're going to be doing a session on preparing complex 1040s. That'll be the course dealing with the types of issues that occur on an individual return when somebody has said, I probably need to go see a CPA. So we'll talk about things like the Section 199 deduction, 199 Cap A deduction, I should say. Talk about things like the AMT, which is less of an issue these days. Talk a little bit about 1031 exchanges. Talk about passive activities and those sorts of things. So just like I said, the kind of things you end up getting on a tax return when somebody decides, my individual return life is complex enough that I need to see a CPA. So that'll be the kind of thing we'll be looking at there. We'll also then on Tuesday have the Advanced Partnership Issues course that features the new partnership audit regime. This course will be emphasizing, and we'll actually start the day with the new partnership audit regime. We'll take a look at how that impacts things, how things are going so far, and maybe what we need to worry about doing going forward in that area. Again, both of those courses will be held this week, Monday and Tuesday, in Sioux Falls, South Dakota, at the offices of Eide Bailly. And you can register for that either on the South Dakota Society of CPAs website or on the Iowa Society of CPAs website. So if you're going to be in that area, you can go ahead and drop by. We'll go ahead and get our course done. Let's see, be interesting, get up there. And I'll get out of this 110 plus degree weather. So I won't be unhappy about these couple of days. So we'll see you up there. Let's start then with our first case for this week, I should say, not this year. We've had a few cases this year. This particular case is a rare Cohen win for a taxpayer. You may know that the Cohen case, I've mentioned before, is the most often cited case in the tax court. We get it mentioned all the time, and normally when it's mentioned, it's not good news for the taxpayer. Because kind of by definition, if we're talking about Cohen, we're talking about a taxpayer who has inadequate, missing, inconsistent records. And that definitely was the case this time. But in this case, the client had just enough information, or taxpayer did, to allow for a sum deduction in one area. But it still was hardly what you'd call a good case for the taxpayer. The case in question is a case of Moore versus Commissioner, Tax Court Memorandum Decision 2019-100. It was issued on August the 15th, 2019. The first thing we have here, this was a taxpayer who was looking to expand his tax preparation business, and he had kind of an odd preparation business. In reality, what this business did was it basically apparently got people who needed returns prepared. It linked them up with individuals who were self-employed who would do the preparation. It would obviously take a fee for that, etc. Well, he needed some more money to get this set up. So he apparently went out with people he had prior business relationships with, and he asked them for money, and he took those advances and called them at various times either investments or loans. They had 9 what he claimed to be promissory notes related to this. Each one had a return on investment of 100% or more, and only one of them was signed. On the original return, he had claimed $161,750 in investment expenses related to the notes. At trial, he said, okay, really it's only $39,500. But the IRS said, really it's nothing. And the tax court agreed with them there. The IRS said, look, you've not shown the advances were actually loans, which, by the way, is always a problem. You can't deduct interest if there's no loan. Was there a loan? He hadn't shown the amounts in the bank account that he claims came from the creditors came from them, and he had not shown the payments were actually ordinary and necessary business expenses. Well, the tax court said, let's talk about this. To be interest, you have to have a loan. And if there's a loan, and they're going to basically get rid of this by saying there's no evidence loans existed, you need a debt instrument, a statement interest will be charged, right? These are sort of factors you look at. Fixed schedule for repayment, collateral to secure that repayment, actual repayment, reasonable prospects of advancement or repayments of funds, and the parties acting as if the transaction was a loan. So we're trying to figure out, in this case, did he meet those requirements? And the practical answer was that he was way short on meeting these requirements, right? It's really difficult. The notes, except for one, were not signed, and there's no indication that the parties had a good faith agreement that these things were going to govern it, right? There was no testimony from the creditors to prove that they were supposed to be creditors, what they were going to do to enforce payment, how they characterized the transactions. There was no stated interest rate. There was no type of security. These things were just awful. They didn't show anything. So the bottom line was the tax court said, yeah, he has no interest expense because we're not really sure what this $39,750 is for, and it doesn't help when you go from $160,000 to $39,750 for what's supposed to be an interest, and then also your interest was 100%. It's like does not make sense as to what he did. So, bottom line, he didn't get a deduction there. Now, the next thing he looked at, though, he was actually better off on. This looked at whether or not he had paid commissions to the tax return preparers. Now, these preparers, he was a clearinghouse for basically processing the returns. And he provided training and support to this group of contractors he worked with. Those contractors maintained and developed their own client base, and they actually did the return preparation. The handling of the return was described by the tax court this way. They said, if they file a return for a client-generated tax refund, the refund will be deposited into one of his bank accounts. Let's not talk about that issue. Just let that one go, okay? We'll let that one sit there. Which he referred to as a third-party bank account and appears to have been treated as an escrow account. He'd take from the refund the preparation fee, right? Did that. And then it would deposit in one of his bank accounts. The remainder would be paid out to the client, right? And from the preparation fee, he would pay a commission to that individual preparer that would range from 60 to 90% of the preparation fee based on the preparer's expertise and client base, and of course he'd retain the rest of it. Now the problem was his records in this area were, shall we say, far from ideal. But interestingly enough, the tax court actually allowed him a deduction based on the Cohen rule. For those of you who don't remember the Cohen decision comes from 1930 court case. Okay, the case comes out of the Second Circuit Court of Appeals 1930 decision written by Judge Learned Hand. And what it says is the IRS had taken taxpayer actually to what was at that point. They'd had an exam. The taxpayer didn't have records. George M. was not good at records. And so they had gone there and said, well, no records, then obviously you can't get any of these deductions related to your business for producing shows on Broadway, vaudeville shows around the country, etc. No deductions for any of these claimed expenses because there was no record of it. The tax court, in this case, the equivalent then, what was the Board of Tax Appeals, the predecessor to the tax court, agreed with the IRS. But the Second Circuit overturned. The Second Circuit said, no, I realize it'd be really nice if he kept all the records. That'd be really helpful. And, and really, we don't want to encourage people not to keep records. But mere lack of records by itself Now, a little caveat here. Congress would add provisions that would say, in some cases, that will be enough to lose a deduction. But until those were added, and that only affects certain expenses, merely not having records should not by itself be enough to knock it out if two things are true. First, if the taxpayer, even without the adequate records or with questionable records, can demonstrate, reasonably that such expenses should have been incurred. Okay? So the nature of the business, he was actually operating the business, and these sorts of expenses are ones that we know he has to have incurred. Some of these expenses. We may not have any idea how much yet, but we know these should have incurred some. And the second prong, which, by the way, when we get to court, tax court cases, the second prong is what normally trips most taxpayers up. The court must have a reasonable basis upon which to estimate how much expense was incurred. In the case of George Cohen, it was, the court felt that they should be able to find such a reasonable basis, and again, it's the Second Circuit Court, so that's a court of appeals. You send it back to a trial court to make this judgment. Now, in this case, the tax court ruled that, well, he's preparing returns. We know they're being done this way. We can see some evidence of how they're being processed. We know he's got all these contractors. He's got 1099s that don't necessarily agree with everything. But he's got all this stuff. I mean, we know he's conducting this business, and we know he has to be paying these contractors. They're not preparing these returns for nothing. So something's going on there. There's no question. So he said, so he meets the first prong. Now the question becomes, did he meet the second prong? And the second prong is, like I said, what usually does it. But in this case, he had records. They weren't consistent. They didn't always show the same thing, but there were records. He had issued 1099s. He had a payroll company issue 1099s to these people. He had some canceled checks, and he had a payroll register. So now again, they didn't agree. Two of them were pretty close, but none of them agreed. And so what the court did, they took a look. We had this by contractor. And what the court did, they looked at the three options. And what the court effectively did was they took the lowest of the three numbers if in fact the evidence did not agree. So, we had three sources for what we paid to Joe. Well, we would assume, we know they paid Joe. And we're going to go ahead and say, and the court wasn't uncomfortable with the number claimed, although again, just like with the interest, he kind of knocked it down. Okay, so he came in with a big number, then it was a lower number. The court came back and said, okay, now we're going to go with a different number. We're going to take a look at what you've got, and so they just basically analyzed those things and selected. At the end of the day, they gave him what was basically the lowest number of his totals. But they did give him the deduction. And the reason it's the lowest is one of the criteria in Cohen is that we are not to award somebody for having kept lousy records. In essence, this is a problem of Mr. Moore's own making. And because of that, we're not going to reward him for not having this stuff together. So based on that, we're going to give him the lower amounts, and that's how it works. The old line from there was, "Thee will not reward the taxpayer for inexactitudes of his own making." In essence, we're going to be sure we don't give him under any criteria more than he really would have qualified for if he had kept all the records, and of course he didn't. So, kind of one of those things. So one of those options. Now, the other final fun part was that the taxpayer, he's a tax expert, he claims, right? He's advertising for tax preparation services. He's advertising this is what he does. Well, and then he said, well, even though I didn't keep these records, I didn't do a real good job. I tried, I tried to comply with my tax burden. Not surprisingly, that didn't go anywhere with the court. He holds himself out as a tax expert. He was a serial entrepreneur. He had done a lot of businesses. In essence, the court said, just your business acumen says you should have known you had better records than this. And they said, secondly, you're in the tax business. That in and of itself, you're claiming to be an expert in tax. No way ever going to say that this is adequate. Your records are lousy. And so we are going to impose the 20% accuracy-related penalty. in this case substantial understatement penalty, on you, there's no reasonable basis for why you had those numbers on your return. It was not a reasonable try to comply with the law. Next up, IRS issues Revenue Ruling 2019-19, issued on August the 14th. This is an issue dealing with retirement plans and checks issued to the retirement plan beneficiary, the participant. And what happens if the participant just doesn't cash the check? And the question is threefold. Should the participant have to pick it up in income in the year in which they were given the check if they don't cash it? Number two, if they don't cash it, now I get to my beginning of the year, I'm putting together my 1099-Rs. Should the plan still issue a 1099-R? And as well, should the plan also have transmitted over tax withholdings, or can we ask for a refund of those? Well, the IRS rules, and I don't think it's going to surprise anybody about this. I think this ruling really sets up, the very end of the ruling may tell us why they issued it. And that is, it's going to set up some other rulings, and they wanted to backstop things by putting this ruling in place. So the plan issues that check during the year. Now, as we know, that check is issued. Taxpayer, for whatever reason, does not cash it. The facts of this ruling tell us that the taxpayer definitely got it. So it's not one of those things where so this is not a fact pattern where the check is never delivered, the check's lost in the mail, the check, there is no other fact pattern. The taxpayer had it and had the ability to cash the check. So again, this wouldn't cover a case where the taxpayer got it, but on the day they got it, there was a citywide blackout because the power failed, the banks weren't open, they couldn't get there. Things like that wouldn't be covered by this. Again, we're saying they got it, they clearly could have cashed it. There was nothing was stopping it. But they just don't do it. Well, not surprisingly, the IRS rules that that's going to be taxable, right? That's going to be taxable in the year paid. Now, interestingly enough, they do not go to constructive receipt or actual receipt. What they go to in this realm is they go to Section 402A and Section 72. And 402A does say that it shall be considered, income to the beneficiary in the year in which it is distributed. So what they're saying is, to a certain extent, is, the IRS is kind of pointing out they want to take a hard line. They could try to argue that constructive receipt, etc., doesn't matter in this case because 402A says you pick it up this year regardless. So, hey, just a little hint there. Don't push too hard. But they do say clearly that the person had the ability, they had the check. There's no way just merely not cashing it is going to change things, right? It's taxable in the year in which the check is issued, even if the taxpayer doesn't go to the bank and cash the check. So we've got that, right? And by the way, it says, and this ruling applies if the taxpayer keeps the check, sends it back, destroys it, or cashes it in a subsequent year. We don't care what they do. They had it at the end of the year. It was in their hand. They didn't cash it. Nothing else has happened yet. It's taxable. Okay, bottom line from the services position. The payor still has the liability to withhold on the payment. You can't get out of the payment saying, well, they never cashed it, so, we're going to cancel off that check and reissue a new one or do something else. No. The payor, they had given them the check. It was in their hands. They could have cashed it, and they just, end of year, they are still holding this check. You've got to withhold the taxes, and you've got to issue the 1099-R. That's not, we're not going to get off of you for that. Now, what's interesting, though, is the very end of the ruling, and I think this may explain why what probably to many of you seems like, well, this was obvious. I mean, that's how it's going to work. Well, here's the catch. The Department of Treasury, it states at the end, the Department of Treasury and Internal Revenue Service continue to analyze issues that arise in other situations involving uncashed checks from eligible retirement plans described in Section 402C8B, including situations involving missing individuals with benefits under those plans. They aren't telling you how those are going to resolve, but that does suggest that there's probably going to be some sort of guidance in the future that's going to deal with those other situations. But for now, what this tells us is somebody tells you they just didn't cash the check because, I just didn't feel like doing it. It was last week of December. I didn't want to go to the bank. It's always crowded out there. I don't like it. I don't care what your reason was. You can't push it back merely by not cashing the check. Next case coming up is the case of Carter versus United States. This is from the United States District Court for the Northern District of Alabama. Case number 5:18-CV-01380. And the case was decided on August the 2nd. This case involves an estate, the estate's executor, and a bit of a fraud. I mean, we got all kinds of pieces here. In this case, the taxpayer died in 2007. You remember a few things were happening about then in terms of with banks and with lending and with all kinds of things and with the stock market a few months later. So what happens is taxpayer passes away. By the time we get to the alternate valuation date, the stock price of this bank stock had declined. Now this bank stock still makes up about 45% of the gross estate. So it's not all the estate, but it's a really big chunk of the estate. Okay? The 706 is filed, the tax is paid, right? And we have this done. Now what happened eventually is that it was discovered there had been a fraud against the bank. And one of the customers, who apparently was related in some ways to those of the bank, had been basically bilking the bank and getting loans and getting money, and essentially turns out the bank eventually is shut down by the state of Alabama. And at the time that the stock is pulled from listing, it's being traded for 6 cents a share. Needless to say, it was worth far less than what was shown on the 706. Now, of course, this is after the date, right, where we go after that original transaction. Eventually, the court decided, or the estate decided, wait, that stock was worth so much less. Really, that fraud was going on back when, the decedent died. And so even though the market was trading at that level, reality is there was nothing there. So, we want to file a claim for refund. Now, the only little problem is the statute on filing a claim for refund had closed. We're past the 3-year, 2-year statute period. So, on paper, we couldn't file a claim for refund. Well, the taxpayer claimed that, the executor claims that she was financially disabled, right? If we are financially disabled as defined in Internal Revenue Code section 6511H, that section provides that an individual who is financially disabled, right, the running of the periods basically for filing your claim for refund are suspended during the period of their life that they're financially disabled. And she had a letter from her, from basically her physician, that after discovering the fraud, and we're going to have to stipulate that when the fraud came to light, the statute was still open. The executor was just distraught. What she thought was net worth, what she thought was value that she had, was now totally gone. So she was distraught and unable to basically, act. It caused her other ailments to go. She couldn't get things done. And so that's the reason why her disability caused her to essentially miss the timely filing of the claim for refund. Now she's saying, okay, I've recovered enough, I'm filing for it. We should be able to file this claim for refund and move forward. The district court started with the first question, because we actually have two questions. First thing is, can you file this claim for refund because you're financially disabled, or is the statute closed? If that's closed, then really everything else is moot. And then the second issue is, if we can file the claim for refund, would you be allowed under these facts? Well, the court said, let's start with the first one. No, you can't. Can't file it. Why? Because this only extends the statute for an individual. And they said, look, Congress uses the term individual in this statute, and it says, in the case of an individual, the running of the statute is told. And they say, well, the estate's not an individual. The taxpayer objects and says, well, quite often in Internal Revenue Codes, estates and trusts are taxed the same way. It refers to persons, and, persons are always considered estates or persons. And so, we should be able to do that. The court has two responses. First, the court says, you got to check your definitions in 7701. If you check the definitions in section 7701, you're going to find that the section 7701 A1 defines a person, right, as an individual, trust, estate, partnership, association, company, or corporation. The court said clearly, and you told me about persons are treated the same, a person, includes all these various things, and an individual and an estate are listed separately in that list. So Congress believes that persons include estates, but an estate is not everything that's a person. And an estate is different from an individual because you don't need to put the two together if they have the same meaning. So the court said, if the Congress had said a person would have the statute extended, then it would work. But when it said individual, we've got to assume Congress meant what they said. An individual limited it to like living, breathing individuals, not to entities like estates. The court also said, secondly, you know what? Even if you had filed this timely, you still wouldn't have won. The court said, look, regardless of what you might like, and regardless of whether what's fair, it is the value on the alternate valuation date or date of death, because you could have gotten the cash for it on that date. You didn't elect to sell it. Well, that's a risk you take. But the fact is, you can't go back and say, well, it really should have been worthless. No, it wasn't worthless at that date. You could have gotten it. And assuming that you weren't aware of the fraud, nobody's going to come back and take the money from you. So, yeah, that was kind of the problem and the issue. So even had they been able to file it, the court said, look, it doesn't really matter. And why would the court say that too? Usually, to some extent, it's just to tell you don't even think about taking this up on appeal. Because I've already ruled, even if the 11th Circuit, or I think it would be the 11th or 5th in this case, I can't remember where we cut off there, but I believe it's the 11th. Even if the 11th Circuit sent it back and, said, well, no, she qualified for economic disability, they'd say we'd still come back and rule that, you wouldn't be able to get the claim for refund. So it's moot it's a moot point either way. Final issue for this week, we're going to take a look at the IRS is going to be sending out per news release 2019-144 issued on August the 14th. The IRS will be issuing refunds of underpayment penalties to 400,000 taxpayers. Now these, you may remember during the last tax season, especially at the very beginning of the refund period, there was a lot of concern with taxpayers' refunds being down and some taxpayers owing tax they hadn't expected to owe. That wasn't really surprising given the way the law was changed and the way the withholding tables they're still trying to figure out how to make that work. But, that was a big thing, and politically it was very touchy, especially early on because of the way it skewed early. So the IRS announced 2 times they announced relief from payment of, from having to worry about having your underpayment of estimated tax penalties due. They issued one level of relief on January 16th when they opened up for e-filing. And then they announced a second round late in tax season on March 22nd. Well, of course, the problem with that was, especially the second tier, was that there were actually lots of people who had already filed their return before March 22nd and who didn't get the second level of relief. Let's remember, generally you have to pay 90% of the tax due, right? But what this said was, and this didn't change the last year's tax exception because last year's tax was still last year's tax, whatever you did. So initially in January they said, well, if you did 85%, you're okay. Okay. In March they dropped that 85 to 80. But of course by March a lot of returns had been filed. Now the IRS said as you file the return, you should file a claim for refund. Well, of course, people didn't do that. They aren't aware of it. Or you just flat out determined it would cost more to file a claim for refund. I think a lot of you may have determined that it would cost more to file a claim for refund than the underpayment penalty the taxpayer got hit with. So it just wasn't done. Well, the IRS now is concerned about that, and I think part of this also just goes to they don't like the PR hit of the fact that, oh man, the new tax law cost me so much money. That doesn't look good. So they're now going to say, and they penalize me for it. So they're not going to just push those checks out. If you didn't ask for the money, you're getting the money. So it's going to pay out the estimated tax refunds to those who filed before relief was granted and didn't file a claim afterward. That's mainly the March 22nd group. Because again, January 16th was the earliest that technically you could file. I guess you could have mailed in a paper return before that date, but you could not have done electronic till after that date. Or secondly, those who on the returns they prepared failed to claim the benefit. Some of those would be true back in January because, again, they announced the relief on the 16th. People were filing for their refunds. The software definitely wasn't updated on January 16th to take this into account. So, yeah, those will be there. The big catch is the IRS will be sending a CP21 notice telling taxpayers they're granted relief. The big problems that we have as CPAs is if a client gets that letter, the perception is, well, the accountant fouled up somehow, right? Obviously, the CPA got it wrong, and how'd you fail on this issue? Now, you're not going to solve that. The best you could do is scan your database, see if there are taxpayers who are probably going to get this letter, and you may just contact them, and you may explain to them, look, the total refund, you paid total underpayment penalties of $22, and this was announced afterward, which means when your return was filed, this was how the rule worked. So bottom line, you had to file a claim for refund, and it's going to cost you more than $22 to have us prepare a claim for refund. Now the IRS is going to mail you out a check. So, when you get that, don't be surprised, and we expect you to get that check. If you don't get it, then, yeah, the problem with opening this up is you realize you're going to be saying if you don't get it, they're going to be calling you back, and now you're going to have to chase it down, even though it's going to cost more than $22 to do it. But that's coming, so just be aware it's on the way. As I've noted each week, we're coming up on, now we're getting into the season when you guys all start hunkering down. We all know that, right? We're coming up on, at the beginning of September, we're always within 2 weeks of a deadline right through October 15th. But after that, you're going to be doing your continuing education. Strongly invite you to check your state society websites for the live courses we'll be doing this year. I'll be presenting in various locations. I'll be in Minnesota doing their tax conference. Actually, tax conferences in Minnesota, Washington, and Arizona. We'll be doing those conferences. I'll also be doing live sessions in various states. I'll be in Idaho doing some live sessions. I will be in Michigan. I'll be in Arizona, obviously, doing sessions. So, we'll be looking for that as we get to later into the year. And in January, I'll be doing some in Oregon. So we'll be all over the place doing these sessions coming up. New Jersey will be coming up as well. I'll be doing that session, I believe, in November. I'll be there in the state of New Jersey. So we got sessions coming up all over the place. Check your records. Check and see when people are going to be speaking. We do have, on the website, I do have a list of the courses I'll be giving live. And I also have those flagged that are available as webcast. If you want to just kind of sit in your office and tune in, we have those available. Many of the states we're working with have those available. Some of the states we're working with are going to be taping the sessions, and those sessions will be available as rebroadcasts. And we'll talk a little bit more about that as that becomes available. But we'll be looking at those sides. So, take a look, see what's coming up, and, take a look at signing up for the courses because we'd love to see you out there in a live course when we're coming to town. This has been the Current Federal Tax Developments for the week of August the 19th, 2019. As always, presented to you by Kaplan and your state societies. You get our regular updates online at currentfederaltaxdevelopments.com. You can follow me on Twitter. My handle there is @EdZollers. You can email me if you have any questions, edzollers@currentfederaltaxdevelopments.com. I also follow discussion groups. I have 3 Connect groups I follow. I'm members in Arizona, Minnesota, and New Jersey. So if you have any postings you want to make to their discussion groups for members of those societies, you can make them there. I tend to read along on the Tax Talk group from California, Cal CPAs. Cal CPA's Tax Talk group is open not just to members of Cal CPA, but any CPA or attorney anywhere in the country, so you can sign up there. I also will tend to look in from time to time on the Tax Pros group on Reddit, /r/taxpros, and that one's open to anybody. You do have to, they will chase you if you're posting questions there that are, you're a non-professional and you're trying to get answers to, doing your own return. That's not what that group's for. But they are open to anybody there in Reddit, so reddit.com/r/taxpros. You can take a look, lots of ways to get into discussion. Well, like I say, we're coming up on this. We're getting here in August. We're shortly going to be into that, hunker down, and it'll be the partnerships and S corps, followed by the trusts and estates, followed by the individuals and C corps. We'll have all those deadlines to play with. So we'll be looking at going into that season. And of course, the way this breaks, that's when the IRS will give us all the guidance. It will be during all that time. We have no time to digest it. So it should be a fun time. We will try to keep you up here every week on current federal tax developments with the current things going on in the area of taxes.